Welcome, everyone. We are doing our quarterly market roundup, and I have the utmost pleasure of presenting this with my colleague, Devon Barrett. Devon is an associate advisor with Francis Financial and has been with us for more than 5 years now, Devon, right?
Yep, closing in on 6. Time flies when
Closing
you're having
on
fun.
six. So, and he is just very well versed in everything investments. He coordinates our investment committee meetings and just an amazing guy to work with. So, thank you, Devon,
Yeah.
for taking this time this morning.
Thank you, and thank you, Avni. And for those of you who don't know, I'm hosting this alongside my colleague Avni Ramnani, who is the Director of Financial Planning and Wealth Management here at Francis Financial. She is a dynamo. She is absolutely just well-rounded and well-versed in anything financial planning and wealth management. So I'm honored and pleased to be able to work with her. She is wickedly talented, and excited to get started with you today.
That's great. Thank you. Thank you. That was very sweet. All right. So, to get started, let's see what we have on the agenda. So we'll go through a quick market review, do some breakdown on the news, and then just talk a little bit about what smart investors do in an environment like this, share some upcoming events with us, and address any questions. Again, for those who are just joining us, feel free to use, there's a chat box at the bottom of your screen. If you click on that and enter your questions in there. We'll address them at the end. All right, let's get started.
Perfect. Perfect. So a recap of last quarter. For those of you who weren't following the news or the markets, congrats, that's a luxury. Unfortunately, there was a lot to talk about, and it all mostly centered around the novel coronavirus, COVID-19. We're in the midst of a global pandemic right now that's really impacted every portion of our daily lives. From a financial standpoint, what we've seen is that unemployment has spiked. Unfortunately, many people have lost their jobs due to this. We're currently in the midst of social distancing, which has caused people to work remotely. And unfortunately, for some of those people who aren't able to do so, have been furloughed, and hence the spike in unemployment. Businesses have been shuttered. Many businesses have been shuttered. Non-essential businesses have been shuttered, which has led to a fall in consumer spending. Travel has almost come to a standstill to try to stop the spread of the virus, which has really impacted the travel and hospitality industries. So just across the board, and this is not specific to any one country or region. Unfortunately, this is something that we're dealing with on a global level. So from consumer spending, from a stock market standpoint, from social, from supply chains, really all aspects have been impacted. So it's no surprise when we look at these numbers here to see just what we were looking at in the first quarter of 2020 as far as the market performance. The name of the game, unfortunately, was volatility. We saw ups and downs across the board. Unfortunately, most of those ups and downs were downs. But, again, based on what we were seeing, really no surprise there for some of these numbers that we're looking at. U.S. stock market was really rattled by this. We saw about a 21% decline in U.S. stocks for the quarter. And again, this is not something that was contained to the U.S. The picture was even worse, believe it or not, in the international space. Developed international, so think about countries like Japan, Canada, many areas in Europe, and then also emerging markets. So you think Brazil, India, China. These markets were down about 23%, respectively, actually. So again, no surprise when we're thinking about the fact that we're dealing with this here, social distancing, but this is something that has really spread across the world in a staggered kind of impacts. That we saw this really first, it became into the social lexicon with China. Many of us associated this with Wuhan, so no surprise on emerging markets. Then right now, many areas in Europe are dealing with this. Italy is a prime candidate of how bad this has gotten in that area. So again, no surprise above international. The one silver lining we're seeing here, the bond market was up. Bonds were up about 3% in the quarter. And that is really no surprise, as bonds and stocks generally tend to move in opposite directions. And this is something that we saw in the first quarter. With why does that happen? Well, when the stock market seems to be acting or reacting to something like a global pandemic and stocks are coming down, what do investors want to do? They want to move their money from something that's viewed as riskier, like a stock, to something that's viewed as safer, like a bond. So we see in this case, stocks went down, bonds were up. Something that we also saw in 2008. In 2008, 2009, we saw stocks were down in this territory, and bonds for the year were up. So something that even though this feels unprecedented in the stock market, there are parallels that we can draw from other crises like the financial crisis and even 2001, 1987. These are areas where we saw something similar, where stocks went down, bonds were up. So again, this shows you the ride that we were on, especially U.S. stocks. It was a bumpy ride. This looks like if this chart without a title, you may think this is like an outline for a roller coaster. Unfortunately, it wasn't a fun one to be on for the quarter. You can see that where we started in January, the S&P was up at around 3,200, and that wasn't even the height. We got close to 3,400 just in February, and that is when the global impact of the coronavirus really hit the markets. And you can see from that point on, we had a steady decline downwards. Not to say that that 20% that we saw in that last slide was just a straight movement down. It wasn't. Unfortunately, the trough that we see right here, right between that March 20th and that April 20th, that was really from thus far the bottom, and that was close to the U.S. stocks were close to down around 35% at the time. So a really precipitous drop is something that we saw in the first quarter. And since then, we've seen a bit of a recovery, which you can see here. It hasn't been just like it wasn't a straight shoot down. It wasn't a straight shot back up, but we have recovered some ground. Like I mentioned, we were at 35 at about the bottom, ended up around 20%. And that, continues to climb up, but in a jagged pace. So it has been a rocky ride. It's been a choppy water. So for those of you who, don't have the stomach for the volatility, it's definitely been something to hold your hat. So what does this mean for U.S. stocks? So it's actually a reversal from what we've been saying in previous webinars and previous wrap-ups, that because we've seen such a drop in the U.S. stock market, the price of stocks right now, U.S. stocks, is actually pretty fair. We were from 2009 on, that 10-year period was a great time for U.S. stocks. For those of you who are invested in U.S. stocks, pat yourself on the back. It was a great time. But the opposite side of that was that U.S. stocks were viewed as expensive. The price was up. Many thought that they were overvalued. If you look at the PE ratio, or the price to earnings ratio, which measures, how much is an investor willing to pay? How much should a stock be priced? So what is the price of that stock relative to what earnings that company is generating? Well, we were looking at PE ratios at this time last year, and even 6 months ago, we were saying, what, U.S. stocks are really expensive. Now may not be the time. If you have some money to look. If you have some money to invest, look at the whole landscape. U.S. stocks may not be the answer. Because of that drop we've seen that the PE ratios are coming in line to a point now where we can say, U.S. stocks may not be so bad, and they may be pretty attractive. So that's something that, another silver lining for those of you who have money on the sideline looking for somewhere to put it. If you're going to invest in U.S. stocks right now, you're buying it at a discount, and who doesn't like a discount? So that's one positive. And as I mentioned a moment ago, this hasn't been unique to just the U.S. This chart shows us how the global pandemic has really impacted just the world in general. You can see that the commonality across this chart is you'll see a negative before the number, and that just goes to show how this has really impacted and shaken up financial markets across the board. We mentioned U.S. was down about 20%. That was pretty much across the board in North America. You can see Canada and Mexico around the same. Developed international, as I mentioned, so many areas in Spain, in Europe, in Spain, France, UK, Germany, all around in the 20s, which goes to show that 23% loss that we were showing before, and then emerging markets. So, China's an interesting one here because you can see mainland China's down about 10%, and that's not something you would expect. You'd say, well, I know that from what we understand that this coronavirus, it really impacted mainland China to start. So I would expect it to be down more. You can see, well, like us, they've also staged a bit of a recovery. So where are we really seeing that decline in the emerging markets? The big one is Brazil. Brazil, like China, is a major player in the emerging market space. And you can see Brazil was really, their stock market was really impacted by coronavirus. We saw about a 36% loss. So again, a takeaway from this is that no matter what part of the world, every country essentially is dealing with this in a different way and is just trying their best to, contain the spread of the virus. And that, of course, is having wide-ranging impacts on the economies of these areas and also the stock market as well. So similarly, we're looking at the chart for the PE ratio for the international stocks, and no surprise here, international stocks are also at a discount. This is something we were saying last quarter and in previous quarters, that relative to U.S. stocks, international stocks are a bargain. This is really, as far as how stocks are priced, as far as is it fair, international really had a discount there, and there was some delta or some difference that could be taken advantage of. So no surprise that, as we saw, U.S. stocks have come down, international stocks have come down as well. So if they were already discount, that discount hasn't gone away. It's still there. It's still there to be had. So stocks as a whole are attractive right now. I know it's and not to say that it won't be a bumpy ride for those of you that do decide to invest, but that if looking objectively at where the price to earning ratio is for these different stocks, it's a good time to to get in at a low point. And if we take a wider lens, how have we looked across the board over the longer term? So, the 1 year, no surprise here, because that sharp decline we've seen in the first quarter has really erased what we've seen last year, which was a great year, but, this year has really been a deep decline. So, across the board, stocks are down about double digits, U.S., international, and developed international, emerging markets. Bonds, 9% from bonds, great returns. Not something you expect to see in more normal times, but for right now, this is a telltale sign of why bonds are considered that safety asset, because when the going gets tough, you see the bonds really show their value. And if we zoom out a little bit further, the 5 year, what we've seen thus far has really unfortunately erased gains in the international space as well. International is about flat, so both developed and emerging markets for the last 5 years, year over year. U.S. stocks, though, despite what we've seen in the last few months, the run-up has been so strong that still is in positive territory of about 6%. And then bonds, this is more in line with what we expect to see from bonds, just a steady ride up over the last 5 years of about 3%, 3.4%. And then if we zoom out to the 10-year, you see green arrows across the board. And that's really what we want to underline there as far as taking that longer term view. Because yes, we are seeing we've seen the ups and downs in the emerging market space over the 10 years. The pandemic hasn't been the only thing to impact emerging markets. Emerging markets tend to be more volatile. That's just by nature. But even that, we still see green across the board. So, there will be ups and downs in the markets. There will be some deep declines like we've seen now. There will be, trade wars and Brexit. It seems like there's always something in the market space. But when we zoom out and we take that longer term approach, it really pays to, ride it out. And you can see that, for those who were invested for the whole period, they experienced positive gains across the board. So it's really important to take that longer term outlook, especially in times like right now. I know it's harder, it's harder to not take it things day by day with what we're dealing with. It seems like our landscape is just so rapidly changing. But just to keep things into perspective, the longer term view, it always kind of balances out in that regard. But, let's switch gears a bit and talk about specifically. I mean, you want to walk everyone through what really happened in the news and last
Yeah,
quarter?
as if, we not that we want to rehash the news that's going on, but during this time, we just want to take what happened during the quarter and sort of break it down and give you some high level tidbits on what's going on in the news and how it's impacting the economy. So, obviously, we'll be talking about the COVID-19 pandemic. We have been, and that's the highlight for this quarter as well. If you go to the next slide, we can see that, how COVID-19 is impacting the US. Obviously, it's all across the world. But the numbers being reported in the US are at an alarmingly high rate. Um, the confirmed cases are nearly 1 million, and then the deaths are approaching 50,000. So it is quite widespread across the nation, more concentrated in some areas than others, but obviously pretty widespread. Moving on, we see that there's been a lot of efforts on flattening the curve, social distancing guidelines have been put into place where pretty much the economy is shut down. Um, it was came kind of suddenly and uh, happened all across pretty much. Some more restrictive than others, but it was a pretty wide net that was cast for good reason. So it was almost before this struck, the economy was doing okay. It wasn't going gangbusters, and it wasn't in the you know down or anything. So it was doing okay. And with coronavirus, the it was as if it was artificially shut down, and it was. People were asked to stay home, nobody go out, restaurants were closed. No, there was no travel, so the economy came to a grinding halt very quickly and suddenly. And that is the impact that we've seen in the markets, in the economic numbers, and so on. Now, the biggest thing the Federal Reserve and the government is looking at is how do we get this back into action? How do we go from where we are today and get back into starting up the economy? Now, there's again been a lot of news around this, and each state is doing its own study and its own version of reopening the economy. But what has the Federal Reserve done? Actually, Devan, if you can go back. Yes, thank you. What has the Federal Reserve done and how has it responded? The central bank has this is uncharted territory for everyone across the world. But the way the US central bank has reacted it's been a whatever it takes approach. They started with very quick two rate cuts. We're down to 0.25, 0 to 0.25 percentage, historically at a low end, but they came there very, very quickly. We've never seen that happen. They have put into place multiple new lending facilities to provide a liquidity into the economy. With businesses shutting down, there was no liquidity. Nobody was buying anything. There was no revenues coming into businesses. People were getting unemployed, so there was no cash circulating in the economy. So the Federal Reserve stepped up in conjunction with the Treasury, and the steps they've taken had been unprecedented. They pumped in liquidity for individuals, for small businesses, medium businesses, and even some large businesses that are very negatively impacted. Um, and they've taken it a step further, and they are now even supporting municipalities and the corporate bond market, which is an unprecedented move the way they've done it. And so quickly, which is what was absolutely needed. These are the lessons that they learned in the past crisis, and the response that they've given in this crisis has just been phenomenal. Now, it may not be enough, and they are continuing to work on, um, they're continuing to work on putting in more uh, aid and more liquidity into the market to support. And the key question is, how do we get back on track, and what impact does all this have? So, that is yet to be seen. We can move on to the next slide. Around, obviously unemployment has risen from a historic low to a historical high in 5 weeks. The unemployment rate for February and March was, it rose from 3.5 to 4.4%. We were just beginning to see the waves of filing for unemployment. And then in April, within just a short 5 weeks, the unemployment has come to 26 million people having filed for unemployment. It's close to 7 or 8% now, and it's likely to go a little bit higher. Um, so we'll see that, in the next slide, how the different branches of the government are coordinating to come together and stabilize the market and the economy. And in various waves, almost phases, about $3 trillion worth of stimulus was passed and is now being pushed into the system. So, all the checks that the government is sending out, the PPP, the Paycheck Protection Program, the CARES Act, all this is an effort to bring in stability into the economy, and it's a very coordinated approach that the Treasury and actually various branches of the government are coming together to do this. Now, this stimulus, if just in terms of proportions, is more than double the size of the stimulus that we saw in the previous crisis in 2008, 2009. So it's really a historic proportion, and it's been done in a much shorter time. Last time we saw the stimulus coming in through different phases over a period of 5, 6 months. This time it's being done within 5 weeks. Things started moving within 2 weeks of this crisis unfolding. So really a lot of effort is being taken for all the right reasons, and they're throwing everything and the kitchen sink at this problem right now. Moving on, we have a lot of material and information that we put out around the CARES Act, the emergency stimulus bill, and we have all this information for you in forms of webinars. So if you weren't able to attend, haven't seen this, want more information, reach out to us. We're happy to share all those recordings with you. And then, moving on, let's talk a little bit, just at a little bit of a higher level, about what the CARES Act was. Again, it's the largest stimulus bill that was passed ever in the entire world. So this is really and it addressed the segments of the economy that felt it the most. It addressed those people who are unemployed. It addressed individuals, it addressed small businesses, it addressed medium-sized businesses, it addresses different branches of the government even. And, the big driver is to keep people employed, to keep people on payrolls, and to help support people who aren't able to go to work and get their income the way they would usually get their income. So it's been, there's been various programs that are being implemented for not just individuals and businesses, and also the bond market. Um, Moving on, we want to talk a little bit about, what all are these programs. Again, we're keeping it at a very high level here. There are direct assistance, including checks, unemployment benefits. This one is a very interesting one. They are now adding an additional $600 on top of what your regular unemployment benefit would be. You will get, if you're unemployed, you'll get $600 a week extra until June 30th, July 1st. So what this has done is, for the bottom 50th percentile of workers, people who fall in that bottom 50th percentile, the bottom half of all the workforce, the impact, the result that this additional $600 assistance means is that they are going to be earning on a per week basis more than what they earned while they were employed. So 50% of the workforce is going to earn more while being unemployed than they did while being employed. This is huge, and it is for now until June 30th, July 1st is what they're saying. But what the impact that it's going to have is, as the economy comes back into action gradually, these people still have the stability to be able to go through that phase, look for jobs, look for employment, all the things that they lost, hopefully get back into the same companies and firms and businesses that they were employed in before. But it's going to take until July 1st, because before that, they're making more money than they would if they are employed. So starting July 1st, we will see a lot more drop in unemployment rates, people getting back into the workforce and getting the economy going. They've also done things like, sending the $1,200 per person check plus $500 per eligible child. This is again below a certain income threshold and addressing the part of the economy that needs it the most. They've also made some changes to retirement plan rules, where for the year of 2020, your required minimum distributions are suspended. You can take a bigger loan from your 401k if you're impacted by COVID. And you can also take money distributions out of your IRA accounts. And there are rules around how much in distributions you can take, how long you can, so that you have 3 years to pay the taxes on that distribution. And within those 3 years, if you don't need that money or somehow come into money to repay that distribution, you're allowed to do that too. So a lot of changes have been made to facilitate that access to cash for people that need it. Moving on, there is a fourth bill that is also being considered. I believe it was passed. I've lost track on how many bills which bill this is, but
Right.
there was a bill that was passed on Friday, expanding the funding. And what this did is the Paycheck Protection Program ran out of funding pretty early on. This bill is augmenting those funds. They approved an additional $500 billion to augment these programs. So that a part of that $500 billion will augment the Paycheck Protection Program. That's up to about 310 billion. There are also tweaks that being made to the Paycheck Protection Program so that small businesses that really need that money will have access to it. It's not just reliant on large businesses having established relationships with banks. So hopefully that helps businesses that have not been able to access the loans. Shoring up the EIDL, the Emergency Injury Disaster Loan Emergency Advance Program, which gave out $10,000 to small businesses for immediate expenses. So there's been a lot of augmenting as well. And the thinking behind this is whatever it takes. We will do whatever it takes. The Treasury and the Federal Reserve has taken that stance that we'll do whatever it takes. The impact that it's going to have, and a lot of people ask, what happens to all this debt? How is the U.S. going to deal with so much debt that's being created? And the silver lining is that because interest rates are so low, the ability to service this debt is more manageable. Yes, it is epic proportion, and there is, the question of how long and can we continue to do this, and who in the world is going to, will people continue to buy it? So yes, those are all the factors that need to be considered. But for now, this needs to be done to support the economy. And that's the stance that the central banks and the Treasury and the government and all branches are taking. Um, Moving on, given all this news, let's talk a little bit about, Devan, if you don't mind, about what smart investors should really do in this environment.
Great point, Abni. And a smart investor right now, the key takeaway of what a smart investor should do is kind of black out the human instinct to react. A lot of the time, right now is not the time to be reactionary. Right now is the time to be disciplined and dig in and follow your core values and your core fundamental investing strategy. So what do I mean by that? So the key is not to follow this chart here. So less disciplined investors tend to follow this path here, where stock market's at a certain point, you're optimistic about where it's going to go, and the stock market shoots up like we saw over the last decades. Let's use 2019 as an example, a year that everything was straight up. So investors say they see these returns and they go, wow, I got to get in on that. So then they buy in at this point of elation right here. So you're buying in right now at the highest point of the market, believing, you know what, hey, I'm in. You got to be in it to win it. It's only going to keep going up from here. This was a great move. But what do we really experience? We experience times where you never know when something is around the corner, whether it be a pandemic, a crisis, a trade war, whatever it is that brings stock prices down a bit, and then investors start to get nervous and skittish and goes, well, I don't know if I really have the stomach for this. Maybe I shouldn't have jumped in so quickly. And then once we get to a point of fear down at the bottom, that investor says, you know what, I'm at the bottom. I got to get off. I can't take this ride anymore. I got to get off. And what have they done? They've locked in the losses. They bought at the highest point, sold at the lowest point, and locked in that loss. And that's the exact opposite of what you should be doing. So the key is not to follow that reactionary path. So that being said, we're at this point right now. The key is not to say, you know what, I can't take it. Because, right now, who knows where the bottom is? But right now, from what we've seen, the bottom was on that point on March 23rd. The bottom of the U.S. stock market was at about March 23rd. Since, if you remember from the chart I showed you earlier, since that point, the U.S. stock market has recovered around 15%. So let's say you were this investor that you stepped off the ride on March 23rd. You locked in that loss right there, and then you missed that rebound that we've seen thus far. So that the key is really just to stay disciplined, keep that zoom out, keep that longer term approach, and then you won't have to deal with these ups and downs. You want your portfolio to be a smooth, stable ride, not a whipsaw, not a roller coaster. So you unfortunately just have to stay on the ride, and it'll smooth out over time once we look back. So when the going gets tough, the tough gets going. And how can you get tough? You don't sell at the bottom. That's how you stay tough. And just to underline that point, that long-term investors went out, like I said, there's something that's always around the corner. And this chart just shows you that, whether it's oil prices, an Arab oil embargo, whether we're dealing with a savings and loan crisis, whether it was the war, Black Monday, which, there are theories. Do we really even know for sure what caused Black Monday? To this day, we don't. There's some theories around what, whether it was computerized quantitative trading. Who knows? But the point is that there's always something that will throw the stock market off kilter. But the key is that it's always recovered. From each of these, we've seen a recovery, whether it be something that at the time just seemed so unprecedented, seemed like we would never bounce back from it, whether it was Black Monday, whether it was the dot-com crash, whether it was what we saw at 9/11, '08. At this time in '08, investors were sure that this was it. That's it. We just lost everything. It's never coming back. That's it. But what we saw from that was that the stock market came back stronger than ever. In fact, it recovered in about 18 months. So, in the grand scheme, that's not that long to have to stay invested to see your recovery. So, again, the key is that you have to stay disciplined because these blips, they happen. If it was just a straight ride up, this would be easy. Everyone would do it. Everyone would just put their money in and we'd be cashing out all day and laughing to the bank. But unfortunately, that's not the world that we live in. The world that we live in is there's going to be ebbs and flows, and the key is to ride out the ebbs so then you can take advantage of the flows when they come back around. Stay invested, stay invested, stay invested. I can't stress it enough. Last quarter, we showed you a chart where, it's key to stay in the market because there are certain days that if you miss out on the highest performing days of the market, you are really shooting your portfolio in the foot. If we looked at, I believe, around a 20-year period from 2019 back to 2000, if your return was drastically reduced by missing just the top 10 days in the market, a 20-year period. Let's think about that for a minute. Just a 20-year period. If you miss the top 10 days, you're drastically you're denting your return. So the key is you never know when those 10 days are going to or happen. And then if you have, if you look at the top 60 days, so the top 2 months in that period, what we saw from that chart was that you actually go into a negative territory. That if you miss the top 60 days in that period, so you just never know when these really sharp days are going to occur. Like I said, March 23rd, things looked really dreary at that time, but then we saw a recovery. And that's the key with where we're at right now. No one has a crystal ball. No one knows really what we're in for, whether we've hit the bottom. Some analysts are saying, yeah, we absolutely hit the bottom. Some are saying we're still in for a bumpy ride. Who's right? We won't know. But the key is that the stock market often reacts and recovers to news like a global pandemic before we feel the impacts as consumers in the economy. So, we may be at a point where you're saying, well, businesses are still closed. I'm still in my home. How could we possibly be out of the woods? Well, we may not be socially, but from a stock market standpoint, the stock market, like I said, it oftentimes recovers well before we see the effects outside. So the key is to stay disciplined, because you never know when that turnaround that we saw after 2008, that steady ride back up, you never know that's going to occur, and you don't want to try to time it, because timing the market is a foolhardy game. Many people try, and almost no one does it well. Not consistently anyway. You may get it right a couple of times. You can pat yourself on the back for that. But consistently, it's not the way to have the long, sustained growth that you're looking for that's really going to carry you out into for whatever your financial goals are, whether it's buying a home, whether it's retirement, whether it's saving for your child's wedding, whatever it is, the key to achieving those goals is to stay disciplined and stay invested. So we recapped a lot today.
We did. And, you all know we are very, we keep a very close eye on what's going on in the market, what's going on in your portfolios. But we are also about how to make things easier for you just through this, and also, building a community. One of the events that we love dearly and we have had such a positive response from is the Money Conversation Circle. We are, uh, we're doing this Money Conversation Circle virtually now. We had one last week and we're doing another one on May 14th. This is how to raise financially confident children. And we're hopeful that we can do it in our offices, but if that doesn't work out, we'll do it virtually. This conversation circle is our first ever co-ed circle that we have advertised anyway. We are bringing together, it's usually for women only. We bring together a group of about 15 women to talk about different topics about money. But because this is such an important topic about raising financially confident children, that we decided to open it up to men as well. So our wonderful male clients can participate in this conversation circle. So remember the date, Thursday, May 14th. It starts at about 6:30, ends at about 9 or so. Please RSVP by emailing Sunana at francisfinancial.com, or you can email any one of us and we'll pass it on to Sunana. So that should be easy enough. If you want, we can just shoot us an email. We can send this to you over email as well.
The gentlemen attend. Yeah, this is groundbreaking. As I'm a man who works at Francis Financial, and not even I have attended the circle. So it's groundbreaking that this is open to us. Everyone attend.
Thank you for that shout out, Devon. We also have workout classes. So here you see a picture of Dr. Laura Miranda, who is our personal trainer. She and our very own Deborah Donenfeld conduct these workout classes every Thursday at 5:30 p.m. over Zoom. And coming up on April 30th, we have yoga with Deborah. And then May 7th, we have Strengthen and Tone with Dr. Laura Miranda. And then again, the following week will be yoga with Deborah on May 14th. So there's a Zoom link. Please send us an email if you want to attend, or just join that link and you can attend. Again, open to clients, friends, family, whoever needs that workout is welcome. Um, we had promised that we would take up questions at the beginning of this. We do have one question that I want to address. The question is, with emerging markets and international funds so low, do I switch my investment mix to put more into those areas to get in while the funds are cheap? I wouldn't be adding money, just changing the mix. Or is that too short term of an outlook? That's a great question. And Devon just addressed a part of it in while he was talking to Ranel. Get started and have Devon add in. Um, the most important thing is that we do not recommend switching your investment mix drastically just because we see an opportunity. We see this more as market timing, because your investment mix must be in conjunction to what your risk tolerance is. Now, if you want to shift this mix, it has to be for the right reasons. It's almost like dating someone, because it has to be for the right reasons. If you think your inherent risk, or the ability to take risk, has gone up, then we might say, okay, let's review what that might look like and then come up with a suggestion. Because as you see, if March 23rd happens again and everything goes down the drain, will you still be okay with the new investment mix? That's the question to ask. So really ask your financial advisor on whether a change is appropriate or not, but know that it has to be done for the right reasons. Do it only if you feel more confident about taking a more risky stance, and then that's the reason to do it. Yvonne, do you have anything?
No, I don't have anything to add. You hit the nail on the head. It's the key is just staying disciplined, right? Sticking to your balance. If you've got a set target, let's say you want a certain percentage of bonds in your portfolio, and those bonds have done better, and they've gotten out of balance because they've grown, as we saw, they've outpaced certain stocks. Well, that would be a good time to mix. If you're going to take from there, take from your bonds to bring it back into line to put it to a stock. Or the key is to stay disciplined. You want to stay in line with your target. I do have another question here, though. It's question: if someone's been waiting to get into the market, how can they know the best time to invest? Example: when the stock markets have bottomed out, and is it safe to get in? Great question, and the answer is you don't. You don't know when you've hit the bottom. You don't know when it's a safe time to invest. So I would turn it back and say, well, what is the goal? What are we planning for here? That's a great question to ask your advisor. If you're planning for something short term, like you're going to make a down payment in 6 months, then that's not the stock market isn't the place for you, because you just don't know what's going to happen in that short of a time frame. It's better to put your money in a safer asset like a 6-month CD or something like that. But if you're planning for the longer term, right, you're planning for your retirement in 10, 15 years or whatever it is, it's a longer outlook, then it's time to get in, right? Because you may see some short-term dips. I can't say that we're out of the woods. I can't say they won't go down in the short term, but as we saw in that longer term view, markets will recover and continue that steady climb upwards over the longer term. So you want to buy in as we're at a relative low point that we've seen. Like I mentioned earlier in the presentation, price to earnings ratios, which is a good measure of how fairly priced stocks are they're showing that stocks are attractive right now. So now would be the time to get in if you're taking that longer term outlook. So the key is to have that conversation with your advisor to see what your time horizon is and to determine the best strategy for getting back into the market.
I just want to add one other thing, and it's related to the question, another question, which is I'm nearing retirement. So, what is that risk? What should that risk level look like? It really does depend, even if you are nearing retirement, because think about it this way. When you hit retirement, and I'm not sure at what age you might want to retire, but if you just say age 65. Even at age 65, you potentially have 25 to 30 years ahead of you. Your portfolio needs to work for you for the next 25 to 30 years, which is a very long time horizon. And your portfolio still needs to work for you and support you during that time horizon. So it's not that, as you hit retirement, you're done, you can't, you should be very conservative. It's not that. It really depends on what your goals are during retirement, um, how much of a time horizon you're looking at, and what your inherent risk ability is. If you have a steady source of income, if your spouse continues to work, if your social security is pretty on the high end, and your expenses are low, then maybe you have the ability to take risks. So there are a lot of factors that go into determining what that risk tolerance is. But I do encourage you to think about that even at age 65, you have a long time horizon in front of you, and therefore don't automatically assume that you should go super conservative at that point. So
That's a great point, Avni, and it's something that it's a misconception I think we commonly see with people approaching retirement, that there's this thought process that once you retire and you start tapping the portfolio, it's almost like the clock stops on the portfolio. And that's not the case, because you're not, typically you're not draining the whole portfolio at once to fund your retirement. It's a gradual withdrawal over the years. So the other parts of your portfolio can still grow for you and recover while you're taking from the portfolio. So we want to warp thinking of some people approaching retirement that I'm approaching retirement, so I don't have time for a recovery. You do, as long as your time horizon is longer.
That's great. I don't see any other questions. We're at about 8:50, so I would wish you all a very good day and a fabulous week ahead. Please let us know if there are resources that we have, if there's anything in specific that we can answer for you or provide for you. We're happy to do that. Thank you, Devon, for joining me this
Thank you, Avni.
morning. And thank you to all of you to join us as well. And
Thank you, everyone.
have a great day today.